Gold just crossed a line that used to sound like science fiction. $5,000 an ounce, not a rumor, not a forecast. An actual trade above $5,000, with prints around $5,100 intraday on January 26, 2026. Let that sink in. $5,000 gold is no longer a theory. And the most important part isn't the number itself. It's what that number suggests about the world that produced it. Because markets don't casually reprice a monetary metal into an entirely new psychological bracket unless something deeper is shifting underneath. This is not just a strong month. This is price discovery. The messy, volatile process of a market trying to decide what something is worth when the old reference points stop working. Here's the uncomfortable truth. Major moves in gold rarely feel logical while they're happening. They feel late. They feel stretched. They feel like they can't possibly continue. And then, if the regime has truly changed, they continue anyway, with pullbacks that punish confidence and rallies that punish skepticism. So the real question isn't, is $6,000 possible? The real question is, what set of conditions could justify a $6,000 print in 2026? What could block it? And what signals can be tracked so the story doesn't come from hype, fear, or a single loud prediction? Because yes, serious voices are already floating numbers like $6,400 for 2026. That doesn't make it destiny, but it does signal something important. The market's perceived range of outcomes just expanded dramatically. Start with the basics. Gold is not a stock and it's not a bond. It doesn't pay a dividend. It doesn't pay interest. It is, at its core, collateral without counterparty risk. A bond is a promise. A currency reserve is a promise. Gold is a thing. That sounds simple, but it's the entire reason gold becomes relevant when trust gets complicated. Gold tends to do its most explosive work when multiple forces lean in the same direction. Monetary policy uncertainty, fiscal credibility questions, currency volatility, and demand that refuses to step away even when price gets uncomfortable. And right now, those forces are colliding. The move above $5,000 was widely linked to investor anxiety around political and fiscal uncertainty, tariff threats, and shutdown fears. All the ingredients that raise the cost of confidence. Markets can tolerate almost anything except unpredictability. And when unpredictability becomes the baseline, gold becomes the default hedge for institutions that can't afford surprises. But emotion is only the spark. The fuel is the plumbing. Because gold doesn't move because a headline exists. Gold moves when capital, real capital, repositions across a global system of pricing venues, leverage, hedging, and physical settlement constraints. That system has layers. There is spot gold, commonly quoted as XAU-USD, which reflects the over-the-counter wholesale market where large participants transact continuously. There is the futures market, especially COMEX gold futures, where leverage concentrates. Futures pricing matters because it amplifies momentum, accelerates repositioning, and forces liquidations when volatility spikes. There is the LBMA ecosystem in London, a major hub for wholesale trading and clearing, which anchors a large part of institutional bullion liquidity. And there are other regional markets, including Asian exchanges, where local demand conditions can create premiums, tightness, and physical flow pressures that eventually ripple outward. A key term shows up in every serious discussion of precious metals: spot versus futures. Spot is the price for immediate settlement, the reference for physical metal and OTC transactions. Futures are contracts for delivery at a later date, and because futures embed expectations, funding costs, and positioning, they often move in ways that reveal stress before the headlines do. When futures prices differ meaningfully from spot, the market is talking. That difference can show up as contango, when futures trade above spot, typically reflecting normal funding and storage costs. Or it can show up as backwardation, when near-term pricing becomes unusually tight and spot can trade above futures, often signaling scarcity, urgency, or funding dislocations. Those spreads don't automatically mean collapse, but they do provide clues, especially in moments of intense demand. Now consider another set of mechanics: inventories and delivery. COMEX warehouse reports categorize stocks as eligible and registered. Eligible gold meets the exchange's specifications and is stored in approved warehouses, but is not currently registered for delivery against futures contracts. Registered gold is specifically designated as deliverable supply for settling contracts. The critical point: registered can change, eligible can convert, and raw totals can mislead without context. What matters is trend, stress, and behavior. R-par. Participants demanding more physical settlement, are spreads tightening, are delivery patterns shifting, are premiums rising, and is the market paying up to access metal now rather than later? That's the infrastructure behind a move like this. Now zoom back into the timeline, because the speed matters. One dataset tracking daily prices shows gold around $4,225 on January 1st, 2026, rising to roughly $4,997 by January 12th, then near $4,936 by January 22, and above $5,000 by January 26. That is not slow accumulation. That is a repricing wave. And that wave didn't start from a calm baseline. Reports characterized 2025 as a historic year for gold, up roughly 64%, described as the strongest annual gain since 1979. Which matters because strong trends attract trend-following capital. When an asset proves it can trend for a full year, it earns a different kind of attention. Systematic strategies, risk parity adjustments, and the dreaded moment when underweighted managers realize they are too wrong to ignore. That is how upside overshoots happen. But a real forecast has to confront the tension at the heart of the gold market: real yields. Real yields are what remain after inflation. If real yields are high and stable, holding gold has an opportunity cost, because gold doesn't yield anything. If real yields compress, because nominal yields fall, or inflation expectations rise, or central banks cut rates, gold becomes relatively more attractive. So here's the twist. Some market snapshots show real yields as elevated. One report described the 10-year Treasury yield around 4.21%, inflation around 2.7%, and a real yield near 1.89%, close to highs not seen since before the financial crisis era. If real yields are high, why is gold ripping? Because gold is not only a real yield trade, gold is also a confidence trade. When markets start to question fiscal trajectories, policy consistency, and the durability of monetary credibility, gold can rise even with high real yields, because the trust premium overwhelms the yield comparison. Think of it like this. Real yields describe the math. Gold also prices the doubt, and doubt doesn't show up neatly in a single yield number. Now bring in the structural demand story, the part that makes the $6,000 discussion more than a speculative thrill ride. Central banks have been persistent buyers of gold for years, not as a trade, but as a strategic reserve asset. According to the World Gold Council, central banks bought a net 1,045 tons of gold in 2024, extending net purchases to 15 consecutive years, and marking a third straight year above 1,000 tons. That is not incidental demand. That is tectonic demand. And in a market like gold, tectonic matters because the market is smaller than most people intuitively assume. Gold has a large total above-ground stock, but the tradable float that actually moves prices at the margin is shaped by liquidity, availability, and willingness to sell. When strategic demand is persistent, it reduces the metal available to satisfy sudden bursts of investor demand. And when sudden bursts hit a market with limited short-term supply response, price has one job: balance the market by bidding high enough to ration demand or to coax supply out, which leads to supply. Gold supply cannot surge quickly. New mines take years to plan, permit, finance, and build. Recycling responds more quickly than mining, but even recycling has limits. People don't melt jewelry in bars overnight unless price and incentives overwhelm sentiment. World Gold Council data shows total gold supply in 2024 rose about 1% to 4,974 tons, the highest level in their 30-year dataset, with mine production and recycling contributing. Preliminary estimates put mine production around 3,661 tons, noting revisions can occur. Another reference point from the U.S. Geological Survey estimated worldwide gold mine production around 3,300 tons in 2024, up slightly from 2023. Different methodologies can produce different numbers, but the conclusion doesn't change. Supply growth is slow. Slow supply, persistent strategic demand, and then a wave of investment demand on top. That combination is how gold gets into price discovery mode. Now add a second accelerant, ETFs and fund flows. Gold ETFs are a major channel for investment demand because they allow large investors to gain exposure quickly at scale. ETF inflows can tighten the market, reinforce momentum, and amplify price moves. ETF outflows can do the opposite. The World Gold Council tracks ETF holdings and flows and regularly highlights how sensitive they are to macro narratives and rate expectations. A third accelerant, regional premiums and local demand surges. When domestic demand spikes in a major consuming region, and when access to alternative stores of value becomes constrained, local gold premiums can rise well above international spot pricing. Reports have described episodes of strong demand in China in 2025, including heavy interest in gold ETFs and elevated local premiums, reflecting how quickly gold can become the preferred store of value in uncertain environments. Premiums matter because they are a signal that physical demand is not purely speculative and not purely paper-based. When premiums persist, they can influence physical flows and over time tighten conditions more broadly. Now, all of that supports a bullish framework. But a bullish framework isn't a forecast. A forecast requires confronting the uncomfortable part, the bearish case. Because gold at $5,000 is not a calm market, it's a stretched market. When price rises rapidly, momentum indicators often become extreme. Using a daily price series for January 2026, a standard 14-period RSI calculation late in the month can land around the 90 range, deep into overbought territory where reversals and violent pullbacks become statistically plausible. That doesn't mean the trend is over. It means the path can be brutal. Here is the bearish case, plainly. First, momentum exhaustion can trigger sharp mean reversion. A market can drop simply because it went up too fast. That's not a thesis change, it's a LAL, average and positioning reset. Second, real yields can remain elevated. If growth stays resilient and inflation moderates, bond yields can remain competitive and the opportunity cost of holding gold can rise. Third, the US dollar can rally. In periods of global stress, capital often floods into dollar liquidity, which can pressure gold in dollar terms even if gold is strong in other currencies. Fourth, policy responses can change the trading environment. Margin requirements can shift. Market structure rules can tighten. Official messaging can attempt to cool volatility. None of that is guaranteed, but it is part of the real-world landscape around a market that starts making political headlines. Fifth, liquidation events can hit everything at once. In a severe risk-off shock, gold can be sold to raise cash because gold is liquid. That's a paradox of safe assets. Sometimes they get sold precisely because they can be sold. So yes, gold could pull back $500, $700, even $1,000 in a nasty volatility event. That is not only possible, it is historically normal for a market in price discovery. Now, here's the key. Those risks do not erase the structural support story. Structural demand is not dependent on a perfect chart. Central bank demand doesn't vanish because RSI is high. Supply doesn't surge because a pullback happens. And once a market breaks a major psychological threshold, it often spends time building a new accepted value zone, a range where participants stop treating the level as absurd and start treating it as normal. That is why the $6,000 discussion should never be framed as a single straight line. The smarter framing is conditional. What conditions make $6,000 more plausible, and what conditions make it less likely? Start with the conditions that make $6,000 plausible in 2026. Condition 1. Central bank demand stays elevated. It doesn't need to accelerate. It needs to persist. Net central bank purchases of 1,045 tons in 2024 and a multi-year buying streak suggest a strategic baseline that supports price, especially if global fragmentation and reserve diversification remain priorities. Condition 2. Real yields compress, even modestly. Compression can happen through rate cuts, falling nominal yields, rising inflation expectations, or any combination. Even if real yields start high, the market trades forward. If expectations shift toward easier policy while inflation remains sticky, that can be powerful fuel for gold. Condition 3. Policy uncertainty and fiscal credibility questions persist. Gold thrives when the rules feel unstable, when tariffs, shutdown risks, and abrupt political turns keep markets cautious. Reports tied the $5,000 breakout to exactly that kind of uncertainty. Condition 4. Investment demand channels reopen. ETF inflows can act like gasoline. When institutions decide they need exposure quickly, ETF vehicles can translate narrative shifts into real demand pressure. Monitoring ETF flow data is one way to see whether the rally is broadening beyond a narrow set of buyers. Condition 5. $5,000 holds as a defended level. This is the technical piece that matters most. A breakout becomes meaningful when the market retests the level and buyers step in. If $5,000 becomes support, not just a spike, the market has a foundation for the next leg. Now, what conditions would make $6,000 less likely? First, a sustained surge in real yields, especially if inflation falls faster than rates. Second, a powerful and sustained dollar rally. Third, a material reduction in uncertainty, not just calmer headlines but genuinely more predictable policy combined with credible fiscal stabilization. Fourth, a drop in central bank demand. Fifth, a shift back to broad confidence in long-duration bonds as a stable store of real purchasing power. None of those are impossible. Markets are chaotic. But the point is this: it is not necessary to guess. It is possible to track. So what should be tracked without turning this into advice? Start with verification, because the only durable edge is independent verification. Verify central bank demand. The World Gold Council's data showing 1,045 tons in 2024 and a long-running net buying streak is a cornerstone of the structural thesis. Watch whether that persists in subsequent reporting. Verify supply constraints. Total supply around 4,974 tons in 2024 and slow mine production growth reinforce the idea that supply cannot quickly neutralize demand shocks. Track real yields. Even one report highlighting a 10-year yield around 4.21% and inflation around 2.7%, yielding a real rate near 1.89%, shows how much room there is for the macro environment to shift. A meaningful compression would be supportive. A further rise would be a headwind. Monitor ETF flows. Investment demand can accelerate quickly through ETFs, and flow shifts often precede narrative shifts on financial TV. Watch physical market signals. Premiums, regional demand spikes, and reports of persistent local tightness, like episodes of heightened demand and premiums in China, can indicate that demand is not merely speculative. And most importantly, watch behavior around $5,000, not opinions, not emotions, behavior. Does the market reject $5,000 and spend weeks below it, or does it defend the level repeatedly, absorbing selling pressure until the level feels ordinary? That behavioral answer matters more than any single prediction. Now, the $6,000 question directly. Could gold hit $6,000 in 2026? Yes. If the current regime persists, and if the market continues to reprice trust risk into the metal. But the move would likely not be smooth. It would likely include sharp pullbacks, sideways consolidations, and sudden rallies that feel illogical. The most credible version of the $6,000 path looks like this: a breakout above $5,000, a volatile retest, consolidation where the market accepts the new range, followed by a second leg higher driven by some combination of real yield compression, continued uncertainty, and persistent strategic demand. That is the scenario. But credibility also means acknowledging what could go wrong. If real yields stay high and stable, and if uncertainty fades, gold can stall. If the dollar swing arges, gold can drop. If liquidity breaks in a broad risk-off event, gold can be sold for cash. And if speculative positioning becomes too one-sided, the market can punish late entrants brutally. That's the reality. So the only rational posture is risk-aware curiosity, not blind conviction. Now, here are the 3 takeaways to hold on to, stated simply, without drama. First, $5,000 gold is a signal that the world is not pricing trust the way it used to. Second, the $6,000 scenario does not require a single catastrophic event. It requires persistence, persistent uncertainty, persistent strategic demand, and a macro environment that does not reward long-term confidence in paper promises. Third, the biggest mistake most people make is confusing direction with path. A market can be in a long-term uptrend and still deliver short-term drawdowns that feel like the end of the story. That brings us to the part that needs to be said clearly: risk disclosure. Gold is volatile, especially in price discovery. Rapid gains can be followed by rapid declines. No prediction is a guarantee. There is no certainty that $6,000 happens or that any particular level holds. Decisions around exposure, timing, and risk tolerance belong to each individual and require independent research, an understanding of volatility, and careful position sizing. And one more time, independent verification matters more than confidence. Verify the data, track the demand reports, watch real yields, watch ETF flows, watch physical premiums, watch the market's behavior around $5,000. Because the most important story isn't a number. The story is that gold is behaving like a global trust gauge, a barometer for how confident markets feel about policy, currencies, and stability. And in a world where confidence can shift overnight, the asset with no counterparty risk doesn't need anyone's promise to remain real.